I think what I'd first like to do is get your take on where we are. We got a Fed meeting next week. Some of the economic data of late has been pretty good. I think you'd admit that. No real sign of recession outside of the housing market, perhaps, and the inversion of the yield curve. But how do you see things right now?
Well, I'd add one other thing, and that's the leading economic indicators are negative year over year and are even more negative if you analyze the last 6 months. So the Fed certainly has had better data to look at in recent weeks. There was a pretty solid employment report last week. And it was funny, we were together at the last Fed meeting on stage at an event. And I remember it was right after the press conference, and I said, you know, my takeaway from the sort of mixed messaging that we got from Powell with a higher terminal rate, but getting a slower path to get there, is that they're not going to do 75 again. And I think that has become pretty well understood by the market. So people are looking for about 50 next week. And the interesting thing as we look forward, though, is that the prediction from the shape of the yield curve of the bond market is that the Fed funds rate should be about the same 1 year from next week as it will be next week. So it's kind of strange that the Fed is going to dig a hole and then fill it back in with raising rates up to about 5% per market pricing and then having to relax it back down by 75. Makes you wonder why you bother with the whole exercise. But that's what we're looking at. Mm-hmm. I do think that, as you suggested, the housing market is just incredible how radically it's reversed over the past year or year and a half. We went from the lowest inventory of all time to one of the higher inventories in terms of months of all time. We've got the mortgage rate up at 7%. And interestingly, the mortgage rate that most people actually have is all the way down at 3.7. So there's this monumental gap between the origination rate and what people currently have, which will be a further breaking to housing. But clearly, inflation has been coming down, which is something the Fed should be looking at. If we look at my favorite indicators, which are import and export prices, they were up in the double digits several months ago, and now import prices are below 5, and export prices are about 6. And the reason I like those, Scott, is that they're not adjusted. They're actually real prices, unlike the CPI, which is all kinds of hedonics and replacements and all that stuff. Mm-hmm. Also, prices paid, manufacturing prices paid have come way down. So I think the Fed is getting it right. We've talked about this all year, about how they were so far behind just several months ago, and now they seem to be pretty much in sync with where the market is. So the economy is going to slow down, mm-hmm. and we keep getting, every quarter, we keep getting GDP revisions for many quarters now that just keep getting revised lower and lower. So, you know, market's down a lot, bonds are down a lot. We talked in recent times about how there was a real opportunity in parts of the credit market. It's amazing how well it's done in just the past 6 weeks or so. Well, we've gotten almost a year's worth of returns out of things like emerging market debt and high yield bonds in just a couple of months. And so, unfortunately, the bond market isn't as attractive as it was when we spoke a couple of months ago. But of course, the positive of that is you've gleaned good returns, just as you have in stocks as real interest rates have come down.
Well, I was going to ask you about that because it's pertinent to the financial advisors we have who are watching this conversation as to whether the generational opportunity in bonds, as you described to me, you know, at that meeting that you suggested we had not that long ago, had passed, just given some of the returns that have already been achieved.
Well, I think it's clearly not as attractive. We have both long Treasury rates are down a lot. I mean, the 10-year Treasury rate is down about 75 basis points from where it was a couple of months ago, and simultaneous with that price gain, obviously, which is like 6 or 7%. You've also had credit spreads come in. So emerging market spreads are in tremendously. The emerging markets had a return of about 8%. In the month of November. So clearly it's not as attractive as it was. So unfortunately, you have to pounce on these things when you can get them. I do think that we're probably going to see rates correct back up a little bit. And when that happens, spreads should widen. So I don't think the bond market, that generational type of opportunity was there. It might come back again with the Fed hiking some more. But I'd sort of be on pause right now because a lot of the easy money's been made.
I wonder what you think about municipal bonds, too, because many of the financial advisors that I speak with on a daily basis continue to recommend that asset class for people. Do you find it attractive? Has it gotten overpriced? Is it, you suggested to me in the past that it had. What about today?
Yeah. It looks even richer now. Municipal bonds were a great opportunity in the middle of this year, and they've richened very tremendously since then. We have a metric that we look at which goes back a few decades, and really it shows municipal bonds to be just about as rich as they've ever been versus U.S. Treasuries. So I don't think there is a great opportunity in municipal bonds at this moment in time. In fact, I just think in terms of high-quality bonds, Treasuries and municipals, the opportunity doesn't seem to be that great. But I will add one important caveat, and that is one of the things that I begin my day with when I analyze the bond market is the ratio of the price of copper to the price of gold, the copper-gold ratio. And it makes sense that that should be a marker for 10-year Treasury rates because copper, of course, is economically sensitive and it's also inflationary sensitive. So when copper's going up, interest rates should go up. And then gold is a flight to quality asset. And so oftentimes when gold is going up, it means that you're in an environment where maybe interest rates are supposed to be going down. So the copper-gold ratio has been pretty out of whack with the 10-year. It predicted this down move in Treasury rates. It showed that the Treasury market yield was way too high a couple of months ago, even by maybe 150 basis points. Now, half of that's gone away, but the copper-gold ratio still suggests that the 10-year Treasury should be below 3, even in the mid-2s. So that is the one thing that corroborates the idea that maybe the market's sniffing out a recession coming in the middle of 2023, because otherwise it would make no sense for this relationship of copper-gold to be so suggestive of lower Treasury rates. But having the move of 75 basis points in such a compressed time frame, I think bond investors or asset allocators should look for a backup in yields and perhaps a widening of credit spreads to really think about re-engaging with that opportunity that was there a couple of months ago.
So you're not necessarily ready to suggest today that bond yields have peaked?
I do think I suggested a few months ago that we were going to see a peak in yields here in the fourth quarter, and certainly that's happened. So we've definitely peaked out for the year in yields. The question is, what's 2023 going to bring? And with all of the negative market action this year, bonds are down even more than the Dow Jones Industrial Average on investment-grade bonds, and stocks, of course, although they've done better lately, like all risk assets, are still down. Particularly on the NASDAQ, quite a lot. I kind of feel like January could start out, as it often does, with buying. I think there's been a lot of tax loss selling. It used to be near the end of the year. In recent years, it's been more like late October into November, and that seemed to have happened, particularly in the bond market. So I think that it's possible that we see reallocation as we enter 2023, which could, I believe we're going to start out with good returns for both stocks and bonds in January, at least at the beginning of the year, as we get kind of reversal of some of the selling that happened to harvest tax losses.
Oh, interesting. Are you entertaining at all, maybe more so than you had in the past, the idea that a soft landing is possible?
It's always possible. Anything's possible. I just don't think it's very likely. It just seems that the Fed is very committed to keeping rates in a restrictive mode. Liquidity is being drained from the system with quantitative tightening. That's something I always bring up when I speak publicly because no one talks about it. It is interesting how the stock market, if you just look at the S&P 500 relative to the Fed's balance sheet, it's an amazing relationship. And the S&P 500 has fallen this year in anticipation of and then in realization of quantitative tightening. So that's a headwind on top of the Fed raising rates. I do think that we're going to see a recession next year. If you look at things like, I don't know, the inverted yield curve, it looks like we're probably 6 months from a recession when you look at 2s, 10s. And some other indicators suggest that a recession could be coming even in 3 or 4 months. When we look at sort of time frames on average at data series in anticipation of recession. So I do think that we're going to be having a recession announced next year. There was a lot of brouhaha over was there a recession in 2022. I never thought we would get an actual officially declared recession this year, but we're getting far along on some of these recession tells. And so I do think that we're probably going to get a recession. And, you know, Jay Powell is increasingly suggestive of the idea that a soft-ish type of landing or a mild recession. I think his rhetoric is in agreement with where I'm coming from increasingly, and that is that it's going to be hard to get just a soft recession. I think we will be looking at unemployment is going up. Most economists expect the unemployment rate to go up towards 5% or so in the next 12 months. That would mean that the unemployment rate crosses its 12-month moving average, which is really almost a guarantee that you're in recession. We're already starting to see some of the real high-frequency data on jobs, which is always the last thing to go in the economy. Unemployment rises late after all other indicators suggest recession's coming, and some of the high-frequency stuff has rolled over. So even jobs plentiful is starting to roll over. So there's still a huge gap there on the JOLTS data, but I do think that the jobs market is softening now.
It's interesting. You have talked about and followed the dollar index quite a bit. It's been on your radar because you were thinking about making some possible investment decisions based on what it's doing. Dollar index, by the way, is now at its lowest level since June, which you suggested was going to happen at some point, and that when it did, emerging market equities would become more attractive. So I wanted to ask you about that, but also because you do mention the gold and copper ratio as something you look at in the market, generally speaking, whether you think commodities in this environment with the dollar index down are attractive for our advisors to think about as well.
Yeah, I do think I'm getting to the point where I do think the dollar has peaked out. It's down at its 200-day moving average almost exactly now. And if the euro were to break above 108, I really think it's an announcement that the dollar has peaked, which does suggest that investments in emerging markets like emerging market equities are probably going to be a good winner in 2023. I think if people want to allocate 401ks and the like, which often they have an opportunity maybe once a year at year end, I would at this point actually say it's time to buy emerging market equities. If you have an annual allocation switch, you should buy emerging market equities really now or first week of January, whatever your opportunity is. I really do think that the time is ripe. Emerging market debt has already gotten some support, so I think it is time for investors. We've been talking about this, Judge, for like a year and a half.
For sure.
I've always said not yet, not yet. But I think this is time to pull the trigger.
I was actually thinking about all of those times when you just said, now's the time. The amount of times you said wasn't yet the time, because I've asked you about it on so many different occasions. But it's interesting, very much so, to hear you suggest that now is the time to make that move. And even if it ends up being a little early, it is what it is.
Yeah, I mean, I was like ready, aim, 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 but now it's fire.
How about commodities?
I'm sort of neutral on commodities. I don't like the way they're behaving exactly. With the dollar weakening, we haven't gotten much of a bounce in commodities. Gold's up a little bit, but it seems to always, in dollar terms, end up around 1,800. So I don't know. I want commodities to move above, like the Bloomberg Commodity Index, the BCOM. I'd want to see that start making progress above its 200-day moving average, and it's been living below it for quite a while now. And so I'm kind of from Missouri on that one. I want the commodity market to show me that it's got some wherewithal. Maybe it's the problem is that we have economic slowdown. Obviously, housing's down, so that's depressing a lot of commodity prices. One last thing, Judge, it's interesting, is we've talked a lot about supply chain and delivery times and all that. I don't know if people are aware of how totally relaxed that situation has become. We went from this incredibly constrained shipping situation where now we're actually down at one of the lower levels in terms of delivery times. So it's just another indicator that the economy is a little bit slower, and so maybe the commodity trade maybe will start to prove itself maybe towards the middle of next year.
It is interesting. And lastly, before we go, the idea that you put forth earlier that you think both stocks and bonds can rally into the early part of next year, does that suggest that at the Fed meeting next week, the chair is going to open the door to that by virtue, maybe not so much what he does, because it's somewhat telegraphed at this point, but more so what he says?
What he says is really going to matter. It really is a weird environment because you've got the Fed wants to tighten conditions, and yet the market keeps hoping for this pivot and is pricing in a pivot in just a few months, and that leads to the stock market going up, and high yield spreads have come in, and so financial conditions have actually eased over the last several weeks, and the Fed is kind of fighting that. So it's a strange dance that's going on with financial conditions. But the markets, I do think, just because of flows, will start the year on a positive footing.
And lastly, for real, though, this time, when you suggest that you think bonds can go up, does the better opportunity exist in the short end or the long end?
I think it's in the long end because I just think even though the rates are lower on the long end, it's historically the case. People always say, why would I buy a 10-year Treasury, say, at 3.5 when I can buy, a year bill at 4.60 or whatever it is? And the reason is that it's the bond market's anticipating recession. So you're going to want capital gains out of bonds, and it allows you to own risky assets. So we're obviously in volatile times, and there's a lot of economic uncertainty. So there's opportunities. I mean, stocks are cheaper than they were to start this year. Bonds are cheaper than they were to start this year. But with these economic conditions, I think you want long treasuries as part of your portfolio allocation so that you can offset the risk that you're taking in cheaper stocks and some cheaper bonds than we started the year with.